financial analysis. I'm going to run through the logistics of this webinar before turning it over to Deborah Lawrence, who will be giving the presentation. This webinar is scheduled for an hour. It will be recorded, and the recording will be posted at our website, www.IEEFA.org/training by Monday, March 9th. All of your lines have been muted. If you have a question, please type it into the chat box that you'll find at the bottom right of your screen. We will go through and answer the questions after Deb has finished her presentation. And now I want to introduce Deb. Deborah Lawrence is the founder of Energy Policy Forum, a think tank dedicated to policy and financial issues with particular emphasis on tight oil, shale gas, oil sands, and renewable energy. She began her financial career in London working in investment banking. Upon her return to the U.S., she worked as a financial consultant for several major Wall Street firms, including Merrill Lynch and Smith Barney. Deborah Lawrence lectures on unconventional oil and gas economics globally at universities, business venues, and public forums. She has appeared on MSNBC, NPR, Chinese, Italian, and Russian TV, and in the documentary Gasland 2. She has also been featured in articles discussing the financial anomalies of shale gas and tight oil in the New York Times, Rolling Stone magazine, PBS's Need to Know, London's Guardian, Tokyo's Sankei, and Mexico City's Indigo. So I am going to start her presentation now. So go ahead, Deb.
Okay, thank you everybody for joining us this afternoon. I appreciate it very much. Kathy, why don't you go to the first slide? I thought we would start out with just some basic terms, kind of go over some things. If this is too simplistic, forgive me, but since this is sort of Nat Gas 101 or Shale Gas 101, I thought it might be helpful. So let's start out with vertical wells. Vertical wells are considered the old-fashioned type of well, where you essentially dropped a drill bit in straight up and down vertically. Horizontal wells are the new technology, and what they do is they drop a vertical well bore straight down into the formation, and then the drill bit turns literally at about a 90-degree angle and moves through the formation horizontally or sideways. It's really incredible technology. They can even make serpentines with it. There's a lot they can do with it. It's really unbelievable technology, and that's the technology that they use in shales. So we're going to be talking a lot about horizontal wells, and they refer to that as unconventional. So you have conventional, I'll get to that, well, we'll do that next. You have conventional wells, which are the old-fashioned type of wells using vertical technology, and then you have the unconventional wells, which use the new horizontal technology combined with hydrofracture stimulation, which you and I know as fracking. Unconventional oil and gas can also include tar sands as well. Shales are the source rock, and interestingly enough, geologists in bygone days used to refer to shales as junk rock. They thought it was just junk and they didn't want to be bothered with it. Now it's pretty much all they've got left. So they've put a good spin on it and tried to make it sound much more promising than junk rock sounds. But shales are the source rock, and so what that means is that that's where the oil or gas is actually made. And then typically what would happen was it would seep out of the shales into a larger fissure underground and make a sea or a pool of oil or gas, which in the old days you could do your geology and you would hopefully identify those seas or pools of oil or gas and drop your vertical well bore down in there and extract the hydrocarbon. Now what they're doing is they're having to go into the rock that actually made it, the source rock. And to do that they have to use fracking, which is basically where they use the horizontal drill bit. They go sideways through the formation and they send out charges, little explosives, and they look like little mini, to me they look like a little bit larger than hand grenades when you go on a drill site. and they perforate the pipe and perforate the rock by shattering it with these little mini explosions, and that in turn releases the oil or gas within the rock. Now the problem has been, well, we'll get to that in just a minute. Let's go to the next slide and keep going through these terms. Okay, resources and reserves. These are very important terms to grasp and to truly understand, because there's a lot of obfuscation that goes on, deliberate obfuscation in my opinion, that goes on by the industry with regard to these terms. When we hear the President refer to 100 years of natural gas, he was actually referring to resource numbers. And resource means the total amount of oil or gas that's potentially available down there in the rock, that it doesn't matter whether you have the technology to get it out or whether you have the business environment to get it out, it's just down there. And that's a very different number from reserves. Reserves are a subset of resources, and that's the oil or gas that the industry thinks they can extract using today's technology and using and working within today's business environment. So you can see that's a very different figure altogether. So when President Obama referred to 100 years of natural gas in his State of the Union address in 2012, he was referring to resources, the total amount available, potentially. But some of those pockets are so small that it would never be commercially viable to even try to extract them. It would just be way too expensive. So a lot of that is just, it's not really a viable number. When you look at reserves, what the U.S. actually has available in reserves is about 11 years worth of gas at today's consumption rates, not 100 years worth. So that's a very important aspect to grasp and truly understand. IP, you'll hear the industry use this term a lot, and it means initial potential. Sometimes you'll hear people refer to it as initial production, but it's basically what the well does in the first 30 days of its life. Now, in the conventional, old-fashioned type of wells, this was a very important number, because whatever that well did in the first 30 days of its life, you could apply a set of calculations to, and you could pretty much come up with an estimate of what the well would do over its lifetime. And they got very good at it, and they were pretty darn close. That has not turned out to be the case with shales. They told us it was the case in the beginning, but it turned out it's not. In fact, the wells with the highest IP, so the highest amount of oil or gas coming out in the first 30 days, if it's a shale well or a tight oil, a shale gas well or a tight oil well, they typically will peter out faster. So it's exactly the opposite of what the old conventional wells did. It's like they have this big explosion at the beginning and then they're done. And those wells will typically be ready for abandonment sometimes as quickly as 2 months later, and sometimes more in the range of 6 months later. But they're not long-lived wells at all. And shale gas and tight oil wells are not long-lived to begin with. The average shale gas well averages, and this is based on actual production history filed with the various regulatory bodies. This isn't our guess. We know that they're averaging for shale gas about 7 years, and then they're ready for abandonment. And for tight oil, they last about 5 to 6 years. These are very short-lived wells. If you want to compare that to the old-fashioned type of wells, some of those wells will last 40, 50, even 100 years. Some of those wells are still producing 100 years later. So this is a very different animal altogether. Okay, EUR. This stands for Estimated Ultimate Recovery. And you'll see this figure a lot when they're estimating the average for a play or the average for a well. And they'll say the EUR is, for instance, 3.0 BCF. And what they're talking about is they expect to get an average of 3 billion cubic feet over the lifetime of the well. That's all that means, EUR. MCF is 1,000 cubic feet. It's the way that they quantify natural gas. And then this is the next thing, pricing parity to crude. It sounds very complicated, but it's really not. All it is a BTU comparison, usually times 7, anywhere between times 6 or 10, and most people take 7. And all that means is that if you're looking at natural gas and you want to compare it to a barrel of crude oil, you got to do it on a BTU basis. So how much energy is actually there in BTUs? And then the price usually falls somewhere in that range. So in other words, if crude oil is trading for $100, then you would expect natural gas on a BTU basis, comparison basis, to be trading for about $12 or so, which is exactly what happened, if you will recall, right before the economic downturn in 2008. In fact, natural gas actually popped up to about 14 and change for a very short period of time. It has now fallen back down to about $2.87, I think it was this morning, $2.90, something like that. So as you can see, natural gas is trading at a deep discount typically to crude, because crude is trading at $50 now, and if you multiply roughly $3 by 7 on a BTU comparison basis, then it's really only trading at the equivalent of a $21 barrel of oil. So it's pretty cheap at the moment. In fact, it's very cheap, which is a significant problem for the operators. Okay, next slide, please. Next slide. Great. Okay, so of the shale plays in the U.S., there are about 32 different shale plays. Most people don't know that there are that many, but there are. However, only about 6 of those out of the 32 have any meaningful production. So when you hear about, you hear a lot of hype about shales, it really is just that in many ways, because most shale plays do not produce enough natural gas or tight oil to even be worth bothering with, frankly. So you have 6 basically that have meaningful production. All the natural gas plays, with the exception of the Marcellus, are already in decline. Now, that's an important point to grasp, because if you think about it, the Barnett, where I live here in Texas, was the first one to come online, and it started in about 2005. So if you think that these activities have been going on at the most, really, for about a decade, and all of the plays, with the exception of the Marcellus, which is the last of the shale gas plays to come online, is already in decline. You can see what I was talking about before, that these wells are too short-lived, and it's very difficult for the operators to maintain a production profile that's either keeps growing or even remains flat for any meaningful period of time. They just, they deplete. These wells deplete too rapidly. All shales, whether they be shale gas or tight oil, are expected to peak sometime between 2018 and 2020. A handful of independent geologists like Dave Hughes and Art Berman have done work, and they have, and even, well, Dave Hughes and Art Berman, they expect it to peak around 2017, 2018. EIA is a little bit more optimistic, but not much more. And EIA, by the way, is the Energy Information Administration, and it's the forecasting arm of the U.S. Department of Energy. EIA is a little bit more optimistic. They think shales will peak around 2020. But again, as you can see, this is not expected to be something that ramps up rapidly and stays, and keeps growing over the next, 2 decades, and then holds a flat production profile over the next several more decades. In fact, Dave Hughes, and I would encourage you, if you haven't read his report, Drill Baby Drill, it's an outstanding report. It's long, but it's an outstanding report, and if you just go in and read the executive summary, that's worth it. But he estimates that the plays will peak by probably no later than 2018, and that by 2023, 2024, which is less than a decade from now, all the shale plays in the U.S. will basically be done. They will all be ready. The wells will be ready for abandonment at that point. So again, very important to understand that this is not expected to be a long-lived exercise. The other problem with shales is the reserves, and as we talked before, the reserve estimates that were made by the industry turned out to be overestimated by a minimum of 100% in the shale gas plays, and in some of the plays by as much as 400 to 500%. Now you may wonder, why on earth would they do that? And by the way, they've done it again with tight oil. Bloomberg did a really good piece on that a couple of months ago. But we were one of the first to expose this back in 2010. The reason that they did this, and the reason they've given such rosy projections, is because the SEC, the Securities and Exchange Commission, changed the rules for oil and gas in 2009, and this enabled the companies to what they call book an expanded, book more reserves. And the reason they could book more reserves is because the SEC expanded the definition of what actually qualifies as a reserve. So when they did that, they expanded the definition of reserves, and shale operators immediately, literally overnight, the shale gas operators began booking exorbitant reserves. And the reason they did it was because, for two reasons. The SEC, unfortunately, in the rule change, did not make it mandatory that these reserves be audited, independently audited and verified. So in many cases, the companies are just claiming that these reserves exist, and because of the rule change, they could also then move immediately into the capital markets and borrow more monies or issue more stock. So they could get more money immediately by claiming these reserves, although they have not been necessarily independently verified. Some companies do have them independently verified, some do not. The problem with that is obvious. We now know that they overestimated the reserves quite significantly, which means that they have borrowed monies on assets that either do not exist or will never be commercially viable to extract. So that's highly problematic from a financial standpoint. All right, next slide, please. This is a good comparison. Looks like the source got cut off a little bit at the bottom, but this is from EIA, the Energy Information Administration, and every month they do a monthly drilling report. And this one is from November. I can tell you right now that this has deteriorated since this time. I can tell you without even looking at it, because the rig count has dropped so dramatically, even in like the Permian, the Eagle Ford, and the Bakken. All right, so if you go down and you look at this slide at the bottom, I've used 2 shale gas plays and 3 tight oil plays, just to give you a comparison. And all this chart means is this shows you how quickly these wells decline. In the Marcellus, about 75% of all the new wells coming online are doing nothing but replacing production that has already been lost from the older wells, and I put older wells in parentheses because they're not very old. The Marcellus has only been going about 4 or 5 years. In the Haynesville, it's even higher. It's close to about 79%. The same thing with tight oil, and these are relatively new plays, even newer than the Marcellus. They didn't really go into the Bakken or the Eagle Ford until probably a year after they had started the Marcellus, and you can see the Eagle Ford is about 75%, so is the Bakken, maybe 74%, and the Permian is about 60%. So you can see how this is a problem. If you're having to drill 60% of your new wells, or even almost 80% of your new wells, and have all the production from those wells do nothing but try and replace the production, the declining production from the older wells, you can see how difficult this is for the operators to get ahead of this game. And in fact, that's why the coin was termed within the financial community of the drilling treadmill. You can get on, but you can't get off. You have to continue in this frenzy of drilling just to try and keep up with the depletion in the older wells, and the operators can only do that for a relatively short period of time. It looks, in every shale play to date, it looks to be about 4 to 5 years, and they've not really improved on that to date. Next slide, please. Oh, I did include this. Okay, good. So I was talking about the deterioration. This is on the Permian, Eagle Ford, and Bakken, and this is between, in the prior slide, you saw the numbers from November in 2014. Okay, so that's the lighter colored bar at the bottom. You can see how quickly these older wells are depleting, especially since crude prices have dropped, and so they can no longer afford to engage in this frenzy of drilling. And so look how quickly the older wells are depleting, and since they can't go out and continue to engage in this frenzy of new drilling, just in that 3-month period between November 2014 and February 2015, the darker bar at the bottom shows you how much deterioration there's been. So now the Eagle Ford, instead of running at about 70, looked like 72% maybe in November, it's now running close to 90% just 3 months later. So you can see that gives you a good picture of how quickly these older wells deplete and how difficult it is for operators to drill enough wells to keep up with that depletion. The minute your price goes against you and you have to pull rigs off, which has happened in the last few months, your economics just go to hell, basically. Okay, next slide. So let's talk a little bit about just basic fundamentals of shales. This is recovery efficiencies, and recovery efficiencies are interesting because in the old conventional type of plays, you could typically, you remember when I stated that you would find this sea or pool of gas and you would drop your well bore in, and to use a very simplistic exercise, I like to say it's kind of like dropping a straw into a glass, and then you extract the hydrocarbon up through the straw, and there you have it. So you could typically, in those types of wells, get 75 to 80% of that hydrocarbon that was in place out by just sucking it up the straw, right? Okay, with shales, because of the fracking and the horizontal drilling and so forth, the recovery efficiencies are very, very much lower. They average 6.5% of how much hydrocarbon is in place. So when you hear people like Dr. Engelder, I hate to kind of use specific examples because I don't really like to personally pick on people, but he did put himself out there on a limb on this one. I mean, he stated that there was this huge amount of oil, of gas in place in the Marcellus. Well, that's fine, but if you can only get 6.5% of it out, it's really meaningless. I mean, you can't. It's an obfuscation to claim that, you know, there are all these trillions of cubic feet of nat gas available, because they're really not available, at least not using today's technology. Could that technology change in future? Of course it could. Is it likely to change anytime in the very near future? No, it's not. So that's something that is very important to grasp, that these are not the same beast at all from the old conventional style of well. Next slide, please. The next slide is going to be on energy returned on energy invested. This is an interesting concept because if you look at how much energy you're expending in order to get a barrel of energy out, it makes sense to look at it as a ratio. And so if you look at this, in the early days of crude, we expended about 1 barrel of crude to get 100 barrels out. That's what that 100 to 1 means. Crude today, we're expending 1 barrel to get 11 barrels out. It's become much more difficult and much more energy intensive to pull crude out of the ground. In tar sands, it's even more dismal. It's 1 barrel to get 3 barrels out. In tight oil, we're still doing the work, but it looks like it's going to come in now at about 5 to 1. So 1 barrel to get 5 out. At some point, you have to begin to ask yourself, are oil sands and tight oil, even natural gas, are they really worth it at the end of the day? Are we expending so much more energy and putting so much more carbon in the atmosphere just trying to get the stuff out? You know, it almost doesn't make sense when you start getting down into these numbers. So just another interesting aspect of the new unconventional oil and gas kind of paradigm. Next slide. Okay, there's some problems with the shale business models. My work is almost exclusively on the finances of shales. So I look at company financials, I look at company filings with the Securities and Exchange Commission, I go through company press releases, etc. This is interesting because during the so-called shale gas revolution or shale revolution, these companies have expended a tremendous amount of money on CapEx. Now, before I lose anybody and you think, well, I don't understand finances and I really don't want to understand financial terms, this really isn't that complicated. All CapEx means is capital expenditure, and it just means how much money have I spent to drill and complete a well. Okay, so this is in billions. You can see we took a universe of 20 different shale companies, and it's all the usual suspects. It's the ones you expect. It's the Chesapeakes, the Range Resources, the Cabots, the EOGs, and Canna, all the companies, excuse me, that you would expect. And we lumped them together, and we added up all their CapEx, all the capital expenditure they had made on drilling and completing wells per annum since 2010. And as you can see, they spent a lot of money, $48 billion in 2010, moving up to $61 billion in 2012. Now the bottom, lighter colored part of the bar is actually how much money they made at the end of the day on these wells. This is called free cash flow, and free cash flow is a metric that I particularly like to use. A lot of analysts like to use it because it is almost impossible to manipulate or be creative with. It is what it is. You can be creative with revenues, you can be creative with net income, you can do all sorts of weird and wonderful things with figures to make your books look really good. But when it comes down to it, at the end of the day, once all the bills are paid, all the money spent, it works exactly like a family. How much cash do I have at the end of the day? Well, those negative figures at the bottom show you how much cash those companies had for every dollar of for all the CapEx that they spent. So, for instance, in 2012, they spent $61 billion drilling and completing wells, and they made a negative. They lost $23 billion of that. So you can have negative free cash flow for short periods of time, especially if you're growing rapidly, but when it turns into a long-term problem, then that's a big red flag for analysts and investors looking at company books, because there's something wrong with the business model. Next slide, please. This is another example of what's wrong with the business model. These companies also, because well, let me back up a little bit. It's my opinion that had we not been in an artificially low interest rate environment, in other words, had the Fed not kept interest rates very low for as long as they have, I personally don't think shales would have ever taken off or been nearly as attractive as they turned out to be. When you're in an artificially low interest rate environment, investors tend to be what we call chasing yield. They're looking for returns anywhere they can find them because they can't go into the old tried and true things like treasuries because the returns are virtually zero and you can't make any money. And so what ends up happening is you create an environment with artificially low interest rates. You create an environment that causes people to possibly invest in things that they wouldn't normally invest in simply because they're looking for some kind of return, any kind of return. That's exactly what happened with shales, in my opinion. If you look at this, shale operators took on an enormous amount of debt, enormous amount of debt. This isn't very probably politically correct, but when I think of this, I wish that I was a cartoonist, because I would love to draw shale operators as big fat pigs sitting at the debt trough and just gorging themselves on debt, because that's exactly what they did. And this slide shows that. These are four of very typical and large shale producers. Continental happens to be almost exclusively in tight oil. Range is almost exclusively in shale gas. Pioneer and Devon, a little bit of both. And as you can see, this is the horizontal bar is the amount of total equity in the company. So that's the total amount that the shares are worth in the company. If you take Continental, you can see that Continental has taken on about twice as much debt as all the shares in the company are worth. So what that means is that the bankers or the investors that are holding the debt are actually holding twice as much. They're holding twice as much in debt as the company is actually worth in equity, and that's a problem. Where you want to see a company is, I put Pioneer in here because Pioneer is pushing the absolute edge of the envelope. If you're a financial analyst and looking at this, you want to see no more than 0.8% of debt to equity, and that's right where Pioneer is. So Pioneer is just pushing the edge of that envelope. They really shouldn't be that high, but it kind of puts the other companies into perspective as to how they just parked themselves at the debt trough and just ate and ate and ate. And now they've got a real problem. Part of the reason that you've seen overproduction in shale gas and part of the reason you're going to continue to see overproduction in tight oil is for this very reason, what this chart is showing you right now. It's because these companies will have to declare bankruptcy if they don't meet debt service, and the only way they can meet debt service is by continuing to overproduce. So that in turn puts pressure on prices and skews the entire market. Next slide, please. Oh, that's it. Okay, good. So now we can open it up to Q&A, which I think is better anyway because we all learn more. So I'm ready.
Yeah, great. So thank you, Deb. So if you have a question, please type it into the chat box at the bottom of your GoToMeeting bar. And the first question is already here. Adam Reeves asks, what will all this mean for all of the steam facilities that have converted from coal to natural gas?
Good question. Very good question. Okay, so something that's been very interesting actually. The utilities that can move back and forth between using coal and nat gas, what we have found is that when natural gas falls down where it is now, where it's quite cheap, around between 250, well, let's just say 250 an MCF, then those utilities switch and start using natural gas and stop using coal. But when natural gas then rises back up between the $4 and $4.50 range per MCF, those utilities stop using natural gas and begin using coal again. And I've got a great slide which shows that band that they've been trading in for about a couple of years now, since at least 2012. So a lot of coal people, for instance, coal activists thought, oh, this is great, nat gas is going to take over and it's a cleaner burning form of energy, and it is cleaner than coal, cleaner burning than coal, although the life cycle emissions, there's a lot of controversy about that. But they thought, okay, this is great, it's going to put more pressure on utilities to use less coal. That didn't really happen. It only happens when natural gas falls down to a price point where utilities think it's more economic for them to use natural gas. As soon as it moves back up to a price point where coal is cheaper, they go right back into coal.
All right. So the next question we have is the figure you mentioned in the beginning that unlike resources, we have about 11 years of reserves. Is that based on the old SEC accounting method or the new one?
That's a good question. That's a good question. I don't know the answer to that, actually. I would have to look that up. But it's probably based on the new accounting method and the reserve estimates. However, they would have, EIA would have based that. Okay, let me back up a little bit. USGS, which is the U.S. Geological Survey, they went in it took them a while. It was about 2012, maybe even 2013 before they published their results. But because there was such a controversy, we made such a controversy about these reserves being overestimated, USGS finally went in and started pulling the production history just like the independent geologists had done, and started looking at what the wells had actually produced. And interestingly enough, USGS came up with figures right in line with the independent geologists. So they recognized that the reserves were overestimated by 100%, and as much as 400 to 500% as well. And they published those results, which corroborated people like Dave Hughes, people like Art Berman. So EIA is probably working off, is no doubt working off USGS numbers. In fact, I distinctly remember a quote from EIA shortly after those numbers were published stating that we're working with USGS numbers now.
Okay. The next question is, what is your feeling about the possibility of the oil and gas bubble bursting and causing damage to Wall Street in general and then the global economy?
Okay, I think the bubble is not really, well, first of all, I don't usually call it a bubble, but if you want to term it as a bubble, let's do it that way and use this as a visual. The bubble is not going to burst, it's just going to deflate. And you've already seen it with shale gas. They pulled rigs out of shale gas in, they started in 2010, really ramped it up 2011, 2012, and went into tight oil. And I think it's funny because Aubrey McClendon made this boastful statement stating, he was CEO of Chesapeake Energy at the time, stating that they were going to do the same thing in tight oil that they had done in shale gas. And he meant by growing it, you know, rapidly. And indeed, they did the exact same thing with tight oil that they did with shale gas. They overproduced and made the price plunge just as they did with shale gas in late 2011, early 2012. They overproduced and made the price plunge. So they basically just copied what they did. I think the bubble is deflating. OPEC saw it. They made a good business decision to not cut production. They haven't raised production, but they're not cutting it either. They recognize that U.S. shale producers in tight oil are the marginal producer, and what that means is that they're the most expensive. And so if you know, the companies, we hear a lot of bragging and boasting from the companies about, I can produce a barrel of tight oil for $50, no problem, $40, no problem. That's, as we say in Texas, that's just BS. They can't. If you go in and look at their filings with the Securities and Exchange Commission where they can't engage in such hyperbole, you find that they're basically producing at $80 to $85 a barrel. So they're in real trouble now. OPEC has taken the price down, essentially, or let it fall to $50 a barrel. OPEC can produce this stuff at about $20 a barrel, so they're still making a profit. They can hold it here for a while and just shake out the tight oil operators. And that's exactly what they're going to do, and it's just, it makes good business sense. And I think if you look at natural gas prices, they've never really recovered since 2012. They plunged to, they fell below $2 an MCF in 2012, but I think the highest they've ever gotten after that was up around 5, and then they fall rapidly right back down again. We've traded in a range of about 250 to 450 since 2011, basically. So the market hasn't recovered, and I think you're going to see the exact same thing happen with tight oil. It's going to take years for crude prices to recover from this. So the bubble is just, it's just slowly deflating.
Okay. And our next question is that it seems like a lot of money has been made in real estate transfers. Are the companies using this money to offset their other losses?
That's a good point. Shale was absolutely 100% a land grab, more than it was ever really about producing hydrocarbons. There's a great quote that I use in presentations, again from Aubrey McClendon, where he boasted that why would I want to drill for gas at $5 to $6 an MCF? And we haven't seen those prices in a number of years now, as I just stated. But he said, why would I want to drill for gas at $5 to $6 an MCF when I can make 10 to 15 times on my money by just flipping the land? And that's exactly what they did. That has all pretty much dried up for them, however. The land grab in the early days, though, it's worth talking about here. Because it was such a significant part of their business model and how they kind of kept this whole ruse, in my opinion, going for as long as they did. What they did was they proclaimed that shale wells, unconventional wells, essentially performed exactly like conventional wells, and they based all their projections on those assumptions. It was a good. I'm not saying that they deliberately lied. They may have truly believed that in the beginning. However, after a period of years, you could go in and pull enough actual production history from the various regulatory bodies that you could see that the company's projections were wildly off. They weren't even close to what they had originally projected. Now, I'm of the opinion that somewhere a year or two before there was enough historical production filed with the regulatory bodies, those same companies absolutely knew what their wells were doing in the field, and they knew that they had a problem, and they didn't disclose it. There's no way they could not have known that their wells weren't having problems. But nevertheless, they did not disclose it, and they continued to play the game. So the way that worked was they announced that these plays, and you still hear this from smaller, unsophisticated operators occasionally. It shows their naivete, but they'll proclaim that these shale gas plays were like a manufacturing model. You just dropped a drill bit in anywhere, you hit oil or gas, and it was all homogeneous. You just extracted essentially the same amount out no matter where you dropped the drill bit in. And that turned out not to be true. I mean, it wasn't even close to being true. And but in the early days, they would go in and they would drill a handful of wells in the sweet spots, the places where they thought they would find the most oil or gas, and then they would proclaim that the entire field was going to hold this amount of oil or gas, and they would flip these fields to other oil and gas companies for multiples. So to give you an example, they might have paid, it was not uncommon for them to go out and lease land from farmers for like $500, maybe up to $1,000 an acre, drill a handful of wells, and then proclaim the entire field what they called proved up, and flip it to another oil and gas company for as much as $25,000 an acre. They made huge amounts of money doing that. And then what happened was these same oil and gas companies who bought this stuff, who had not done very good due diligence, found themselves holding assets that basically disappeared on them overnight. That's why you've had these several rounds of these huge asset write-downs in shale companies. The first round was in 2009, then the second round happened again in 2013, and we're about to go into the third round with tight oil in 2015. It's just around the corner. You'll start seeing it here after the first quarter. And you're going to see billions and billions of dollars written off by these companies in shale assets.
So the next question is, noting that this was a U.S.-centered talk, can you talk a bit about the situation globally?
Sure. Do you want to talk about gas or tight oil or both?
I would.
Why don't I just, yeah, since it's a written question, why don't I just kind of quickly talk about both? Okay, so other countries would like to be able to repeat the shale gas revolution, or so they say, in their country. It's been interesting what's happened. If you go into China, they basically, the place where shale gas is the most prolific in China is also the place where they have the least amount of water. The landscape is very difficult to work, and they've basically backed off of their early projections of what they thought they could get out for shale gas. Poland was supposed to be the shale gas savior of Europe. And then the Polish government invited, when the controversy became very heated in the U.S., the Polish government decided that maybe they should invite the USGS to do exactly what they did in the U.S. in Poland and have a look to see whether the operators had given them realistic numbers, and it turned out that the operators had not. The USGS downgraded the Polish shale gas potential by about 85%. Exact same thing happened in India. The shale gas potential in places like France and Ireland and Romania was purported to be tremendous, and people rose up in those countries and asked for bans or moratoria, and indeed they got them. So you're seeing the oil and gas industry having a lot of problems globally trying to push this idea. People just don't like the idea of fracking. But I think there's also something else going on there. I really think that the energy paradigm overall is just shifting. People want to move away from hydrocarbons for a number of reasons, and there are good business reasons to divest and move away from hydrocarbons. So I think you're seeing pressure there as well. So I hope that answered the question.
So there are a few more questions left. I'm going to take this one out of order because it's an important clarification.
Okay.
Could you explain what you mean by tight oil, and is that the same
Yes.
as crude?
Yes. I'm sorry. I thought that I apologize. Okay, so tight oil is just oil from shales. So in shales you can either get almost exclusively natural gas out of it, which they call shale gas, or you can get natural gas mixed with what they call liquids, which is natural gas liquids, or you might also see it termed NGL. I thought we were missing one of the term sheets in my slide presentation, and that was it. Anyway, I apologize for that. Yeah, I apologize for that. So if you could put that up, that would be great. So you can have NGLs or natural gas liquids mixed with natural gas, or you can have a combination of kind of all three. You can have, and NGLs mixed with natural gas is what they call wet gas, and then you can have tight oil, which is crude from shales. And so that's all it means, tight oil. And the reason they call it tight is because the rocks are tight. It's not just a sea or pool of gas. It's held tight in the rock, and the rocks have to be shattered in order to release it. Flaring, to go back to the slide, flaring is when they burn off the natural gas, and most of you have probably seen those. Well, I don't mind using the word. I think they're mortifying, those Google Earth shots of the flaring at night in the Bakken and the Eagle Ford, where it looks like, I mean, the Bakken is just a bunch of cow pastures, and it looks like, you know, a major city, and it's nothing but them burning off natural gas because they don't have any. It's so cheap, they don't have any use for it, and they're trying to get the crude out. So to my mind, that's a horribly irresponsible management of our natural resources. But that's for another day, I suppose. But that's what flaring is, and it's an antiquated process. It's not, they claim it's used to clean the well bore in many cases with natural gas wells. It's not necessary. They can do what is called green completions, but green completions cost more money. And because their margins are already non-existent, they don't want to spend the more money. So they insist that they have to flare, and they don't. In fact, flaring is banned in, I believe it's all first world countries except the United States, but we still allow it, which is unfortunate. And then LNG just stands for liquefied natural gas, and what they have to do is, if they want to ship natural gas to Asia or Europe, export it, then they have to convert it into a liquefied form, and again, that's very energy intensive. So kind of go back to that energy returned on energy invested. They expend a huge amount of nat gas just trying to liquefy nat gas. They put it into these tankers, these funny looking tankers that have these globes on them where they store the liquefied natural gas. They ship it to Asia or Europe, and then they have to reconvert it once they get there into gaseous form, and so they expend a lot more energy trying to reconvert it from a liquid form into gas again. It's really the most insane energy model you can imagine, but that's where we are today in terms of the energy markets. So I hope that clarified it, and I apologize that that got skipped.
Yeah, that might have been my fault as well, doing the slide, sorry. So there's two more questions here. One is just to confirm on the first question that you answered. So once power plants have been outfitted to burn natural gas, the companies can switch back to coal easily?
Yes.
Is that correct? Okay.
Yes. Well, if they have that ability, there are some coal plants that they can only be run on coal, and they can't switch back to natural gas. But if they have the ability to switch back and forth, that's exactly what they're doing. They're not moving away from coal for any meaningful period of time, which is unfortunate, but they're not. They're just doing whatever gives them the best economics at that particular moment.
Okay. The next question says that you said that extracting shale is not worth it because of the low percentage that they're able to recover. Do you mean not worth it in the long run? And isn't 6% of trillions of cubic units enough to make money for these companies for a long time and even support at least a few economies?
Well, I mean, I showed you the numbers for how much they've spent on CapEx and how much they've made. So apparently it doesn't work because they haven't made any money. And in spite of all the rhetoric about, you know, this is game-changing and revolutionary, they have produced a lot of hydrocarbon in the early days. That makes it look extraordinarily successful, but it's really not. It's kind of a smoke and mirrors scenario. And the reason is just it's the very nature of these wells, whether they be gas or tight oil, to release the most hydrocarbon they will ever release in the first 12 months of their life. And they've gone in and they've tried refracking later, and it doesn't increase that production number. So if you go into a play and you engage immediately in a frenzy of drilling and you bring a lot of wells online all at once, and all those wells produce the most hydrocarbon they will ever produce in the first 12 months, then it looks like it's an enormous success. The billion-dollar question isn't whether they've produced a lot of hydrocarbon in the first year or two. It's can you still maintain that level 5, 6, 10, 20 years out? And the answer is unequivocally no. They can't even maintain it after 4 or 5 years. Those slides that I showed you where the percentages, you know, where I said that 80% of the new wells are being used to offset the production, that's what I'm talking about there. They're having to drill 80% of their new wells that are coming online are doing nothing but trying to replace what they've already lost in the older wells that are only like 2 years old. So that's why they move from play to play. If you look at the pattern of shales and think about it, first it was the Barnett, and the Barnett was just, you know, the greatest thing ever. Then it was the Haynesville, and the Haynesville made the Barnett look like peanuts, according to the industry. Then it was then it was the Fayetteville, and then it was the Haynesville. Then it was the Marcellus, and the Marcellus was just so great that we didn't even need to think about the Barnett anymore. Well, the reason they didn't want us to think about the Barnett anymore is because the Barnett was already 4 years old, and the declines were already getting pretty precipitous, and they wanted to take the spotlight off of that. So every shale play is always bigger and better than the last. Now, what happened was they could play that game for a certain number of years, but then they ran out of shale plays. There are 32, as I stated earlier, but only 6 of them really managed to make enough hydrocarbon to make it worth anybody's while, and they haven't been able to find another one. They announced after the Bakken and the Eagle Ford, and they had said that was, what did they say, the Eagle Ford was the equivalent of 2 Saudi Arabias, which was total rubbish. But then they announced that the Monterey in California was going to be even bigger than that because they were already seeing depletions in the Eagle Ford that they didn't want to admit to. Now, what happened to them in the Monterey is that the Monterey turned out to be a complete dud. And EIA went in and downgraded the company projections for the Monterey by 96%. The Monterey is basically a non-starter as far as shale oil potential. So it's interesting, you know, the public relations game that was played around this.
So our next and final question is, so if there's about 11 years of gas, what is the economic thinking behind companies building huge pipelines in New York and New England?
Well, that's a good question. You know, there's a lot of money. Investors will put money into pipeline MLPs, basically. They want them because they can get their money back. They get a good return, typically. And there's no reason to see that will change in the next couple of years, and so monies will still pour into that, and that means the Kinder Morgans of the world still have a lot of money to go out there and build pipelines. will they be able, will these MLPs look as, will the returns be as great as they are now, even 5 years from now? I don't think so. I think you're going to see some definite problems. You can see hints of this already. There was a company called OneUp out of Oklahoma that wanted to build a pipeline from the Bakken down to Cushing, Oklahoma, and they went, usually you can raise monies for pipelines because pipelines are essentially cash cows. They're very expensive to build and you spend a lot of money up front, but then once you've spent that money, and if you have hydrocarbon that can run through there for decades and decades, then you have a cash cow on your hands, and investors love that, and they'll throw money at that all day long. But what happened in the Bakken was they went around and they tried within the industry to raise funds to build this pipeline, and nobody would take them up on it. They had to abandon the project in the end. And I wrote a piece about this at the time. This was about 2 years ago, which got picked up by a lot of industry publications because I think they recognized what I recognized, that the reason they couldn't raise the money for this pipeline coming out of the Bakken was everybody knew that the Bakken was going to be short-lived and they weren't going to have a cash cow on their hands for decades and decades. And so by the time they threw all this money into that pipeline, those wells would be that play would start to go into decline, and they wouldn't have this cash-generating machine on their hands. Now, as long as investors are throwing money at pipeline companies are going to take it, they're going to accept it, and they're going to go out and look for opportunities. You can't blame them there. Will their returns be as good 5 years from now? I doubt it. I just don't see that. I think the same thing happened with shales. You had a lot of investors throwing money at shales in the early days. They took it. They accepted it. You can't blame them for that. But the wells didn't make money, and now you've seen particularly institutional investment in shale companies has dropped dramatically. Why? Because pension funds and large hedge funds and large institutional investors overall have gotten burned badly. If you look at Sumitomo, their net income fell by 95% in 2014 because of their shale investments. So you've got people out there that have been burned. I think you're going to see the same pattern play out with pipeline companies. Just hasn't happened yet.
All right. Well, we are coming up on 5 o'clock now, and so I think we're going to close out the webinar. We don't have any more questions. So just to remind folks, this webinar has been recorded, and it will be posted by Monday along with Deb's presentation on the Institute website, www.IEEFA.org/training. So thank you all very much for attending, and we look forward to seeing some of you at Energy Finance 2015 in New York in a couple weeks.
Thank you.
Thank you.